The technicals here are pretty clear. Disney shares are down about 18% since the company won the vote. Based on Scott Wapner's reporting, Peltz exited shortly after that vote when the shares were right around 120 a share, as we said, today around 100. As an investor, what's this all mean to you?
It doesn't mean much. Again, we're investors, not traders. And obviously, Peltz and his hedge fund came in. It was fairly short-term money. They agitated for some change. They claimed that they got what they wanted. And look, it's a tidy little profit for the firm. But we continue to look at the business longer term, not 6 months, but rather over the next many years. And, we still think there are things to like at Disney.
All right, so a lot of things you see to like. The company has said they believe that their streaming business is going to turn profitable in the near future. Still some questions about the succession plan. Just the reaction in the stock. Does that mean that investors, most of them, maybe not you, but most of them believe that Nelson Peltz was actually right about a lot of his concerns? I mean, how do you interpret this reaction?
We have to remember where the stock has come from. It was doing really well going into the most recent earnings report, and really kind of up to where, it seems that Peltz and Tryon had held their shares. I mean, the stock started the year at around 90 a share. We got up to 122 or so. Sounds like that's about the spot where Peltz sold. Hey, again, great trade. Nothing against what they're doing. But we had a big move. We had a big move off of a fairly low level in the stock. So I think at some level, it seems convenient to say, well, look, Nelson Peltz sold at 120, and since he lost the proxy battle in April, the stock has pulled back. Maybe that means something. But, we think it's more of a reflection of just the run the stock had over a short period of time. It was oversold. They had a couple of good quarters. They're taking costs out. We're seeing profits going up. I mean, look, EPS was up 30% year over year in the most recent quarter. But as you noted, they're still not profitable on the direct-to-consumer side. The box office has struggled. The succession plan is still up in the air. So the stock had run quite a bit, but there's still a lot of unanswered questions. So I think a pullback is somewhat warranted.
Yeah, also, you didn't even throw this in here, some questions about ESPN and also some questions about the Marvel
100%.
Cinematic Universe going forward.
Yep.
After a couple, not flops, but didn't do as well as thought. So, Jason, I got to ask you, as we've seen the stock decline about 18% since that proxy battle, looking to add more at this level? Is this possibly an opportunity to up your stake?
I think for long-term investors that don't own any, it's a good entry point around 100. I think for folks who are underweight the name, it makes sense, to lean into it. If you think that the direct-to-consumer, the streaming business is going to turn profitable, which we do. We think by the end of the year, we're going to see profitability begin. And then we think in the out years, as we look over the next few years, there is a number of levers at Disney Plus and ESPN as they go to streaming where we think that can contribute meaningfully to profit. We own a sufficient amount of Disney, so we haven't been adding to it. We like our position. We like our sizing. But yeah, again, if you're somebody who's interested in the stock and you think that there's upside, I think, at the current price, it makes sense.